OECD focus in transfer pricing, the term business restructuring does not only mean changes in the overall company structure. It also covers modifications to the business model that affect the allocation of functions, assets, and risks between related parties. For example, a restructuring occurs when production is relocated from one country to another, when a full risk distributor is converted into limited risk distributor, or when intellectual property rights are transferred to another group entity. Restructuring may also include outsourcing certain functions, transferring R&D teams, or significantly reducing operations in a given country. According to Chapter 9 of the OECD Transfer Pricing Guidelines, every restructuring must be examined under the arm's length principle. This means that if functions, assets, or risks are shifted between group entities, the restructuring must be analyzed as if it had taken place between independent parties. A key question is whether the entity losing functions or profit potential receive appropriate compensation, often referred to as an exit fee. OECD also stresses that not only large or obvious restructurings are relevant. Even if EBIT changes are less dramatic, a restructuring may still require transfer pricing documentation if it results in a real shift of profits within the group. For example, if an IT development team is transferred from one entity to another and the original company loses its know-how and income potential, this qualifies as a restructuring under OECD guidelines. What are the taxpayers' obligations according to OECD? First, prepare transfer pricing documentation describing the restructuring, including the rationale and expected financial effects. Second, conduct a comparability or compliance analysis to confirm that the terms are consistent with the arm's length principle. Third, assets and document any compensation for the restructuring. For example, whether the entity losing profitability was appropriately remunerated. Fourth, reflect the restructuring in the master file if the group is subject to this requirement. 5. Ensure consistency of reporting across all countries involved, since tax administrations will expect the restructuring to be explained in a coherent manner. Conclusion: OECD rules do not set a quantitative EBIT threshold like some national regulations do. Instead, they focus on the principle. Any restructuring that leads to a relocation of functions, assets, or risk must be analyzed under arm's length conditions, with proper documentation, benchmarking, and where applicable, appropriate compensation. Thanks.